Hi, hello, hi, and good morning. Welcome to today's edition of Market Analysis Pre-Market for today, August the 29th. I'm Giovanni Benacourt, operator and educator with Vantage Markets. Well, what a Friday, huh? Federal Reserve Chairman Jerome Powell talked tougher and more briefly than market expected. The result wasn't good. Stocks fell hard. They're down again today, and bond yields are higher. It looks like Powell might have killed the growth trade that was working so well the past few weeks. Between mid-June and mid-August, the Nasdaq Composite was up a whopping 23%. That's a bull market by some definitions. But of course, the Nasdaq didn't come close to highs set last November. Regardless of how it's labeled, the market was on a tear. FANG stocks gained 28% over that span. Shares of honorary FANG member Microsoft rose 19%, and Tesla jumped 44%. That looks to be over now. Stock fell with a thud on Friday after Powell's hawkish 10-minute talk in Jackson Hole, Wyoming. The Nasdaq ended down almost 4%. FANG stocks plus Microsoft and Tesla dropped 4.2% on average. Nasdaq futures were down another 1% on today so far. And the 2-year Treasury bond yield was at a new 52-week high, hitting about 3.48%, levels not seen since 2007. The market action, and especially the bond yield, shows that investors and traders are just getting used to the idea that interest rates might go higher, faster, and remain elevated for longer. Persistently higher rates tend to take the air out of stock valuations. The Nasdaq trades for about 20.4 times estimated 2023 earnings. The price to earnings ratio fell below 21 times back in June. If 20 times is the cards as the Fed squeezes inflation out of the economy, it's another drop of at least 10% from Friday's levels. A 10% drop is called a market correction. It will be a correction from what feels like the fastest and shortest bull market in its history, very similar to Powell's speech. It's not easy to get a prediction that wrong, uh, and just to change the tune, and especially on a matter of global importance. But in this case, a whole handful of banks call it wrong on the trajectory of Russia's economy. Wall Street giants have predicted Russia's economy to resemble a train wreck in the aftermath of Western sanctions. That isn't quite what happened. In fact, some data actually point to strength emerging from Moscow's economy. Some top investment banks rushed to predict Russia's economy downfall when Vladimir Putin first ordered the invasion of Ukraine 6 months ago, but analysts have since had to walk back some of their forecasts. The current data coming out of Moscow does not point to an abrupt plunge in activity. This is what JP Morgan strategists wrote in a note. The foreign exchange is tuned recently after it had forecasted in March that Russia's GDP will drop 35% in the second quarter. So the GDP profile, therefore, looks increasingly likely to be consistent with a drawn out but not very sharp recession. Soaring crude exports and high prices have been a boom for the Russian economy, and the IMF said the Kremlin's program to keep unemployment low has been effective so far. Moscow's ability to pivot toward Asian customers for export has also helped insulate it from Western sanctions that were expected to crush the economy. Goldman Sachs had said 5 months earlier that Russia will struggle to find new trading partners amid war, but China and India, among others, have emerged as big buyers of Russian energy commodities. India alone has seen a 900% increase in their supply since February. All the while, the EU still hauls in 2.8 million barrels a day despite its own sanctions on Moscow, and this is what Bloomberg data shows. And factory and service data too show the Russian economy is chugging along at a steady clip. Strategists at Goldman previously highlighted that Russia's composite purchasing managers index suggested steep economic declines loomed. Immediately after the invasion, that figure slid from 50.8% in February to 37.7% in March, but later the same data returned to growth territory. The most recent number came in at 52.2, one more signal of a strong economy that stands in stark contrast of Wall Street expectations. With that being said, let's take a look at what we can expect at the open. So we saw Friday, obviously, plunge of the Nasdaq. We found some support right around 12,400 points. From there, it has traded in a range consolidation stage, accumulation, obviously the weekend. And so as we wait for the bell, the consensus is that the market will continue to plunge. We have our support very close to where the market is at. I will assume that if we do happen to continue this movement to the downside, obviously we're going to be opening up with towards the lower end. 13,300 will be obviously taken out, and 12,000 will be the obviously the target. So let's take a look at also the S&P. Same wise, 4,000 is just real close by. I would assume 3,900 will be somewhere. Should we come into to play for the downside? The RSI is just barely right on the limit, on the edge right there of being oversold. And then we have crude oil, just ramping its valuation higher. 94.50 will be our initial first psychological test of resistance, and then 95.6 is where I have my resistance. RSI is still not overbought, so we could probably see a run towards 95. So that's bullish on crude oil. So that therefore, inflation is keeps on receiving that pressure from crude oil prices. Then we have natural gas that took a nice little plunge below our resistance, but it violated our resistance, but didn't break it. From there, it has retraced, looking to perhaps come back and take another attempt up at really 970. But initially, we need to overpass our psychological resistance of 950. Okay, that's important for us to take a look at. And then we have gold. Gold is just really hyperbolic movement to the upside. We have our pivot point at 1742. That will be obviously our initial resistance. RSI is in neutral, so there's still a lot of room for it to continue to rise. Our 50 moving average is creeping up on our market, so it will act as resistance. I have 1750 as my resistance, and that the 200 moving average is way above our resistance, so it could also act as another resistance. Let's take a look at now at silver. Silver has it found support at 1850, and from here it has looked to come back higher above 1880. RSI is neutral. The 15 moving average is real close to our pivot point, so $19 is the psychological resistance level. And then we have copper. Copper really, this movement, so the downside, finding support at 354, this could really just show me a possible dead cat bounce. Should that happen, obviously, then we want to be able to use our Fibonacci retracement tool to find out our support, our resistance initially. So we will find our initial resistance of 0.38, right around 3.63. Okay, and from here, our 50% retracement or resistance will be 3.65. But should we do a dead cat bounce, okay, then obviously we want to be able to see the market just start to retrace from this point. Let's take a look at what our support levels will be on this persistence. So on this case, our support level, the 0.38% will be 3.58. Should we come in here and find that it is going to be a dead cat bounce continuation of this drop, we want to be able to come in and obviously break our golden ratio, our 0.618 valuation. So from here, anything lower from here, we could probably see a continuation of this previous move to the downside. Otherwise, we could probably be able to see that we are coming to our 360 psychological resistance level. So we could break that and move higher, but we have the 200 moving average right about that, acting as a dynamic resistance level. So keep an eye on that. But I'm bullish on copper anyhow. Then we have Bitcoin. Bitcoin is just really trying to sustain itself right above the psychological level of 19,500. But if the Nasdaq does continue to move lower, obviously it will pull the Bitcoin with it. RSI is neutral, so anything can happen here. Then we have Euro. Euro is trying to really sustain itself above parity, and if it does happen to stand above parity, it will depend on what the dollar index will do. 108,500 is obviously our support, psychological support, but 108 is our level right now. If the dollar index continues to fall and breaks 108,500, we most likely will see a 101 euro. Okay, well, that's it for our market uh, analysis for pre-market for today. See you later on. Have a nice trading day.